Welcome to this edition of 401k and Beyond. So we want to thank all the viewers who are watching this. We've got our Facebook group, which is 401k and Beyond. So if you're watching this on there, be sure to check out our YouTube channel of the same name. We do some additional content that we post to the YouTube channel that we don't necessarily want to fill up the Facebook group with. On the reverse side, if you're watching this on our YouTube channel, be sure to check out the Facebook group 401k and Beyond. We get some good interactive discussions on there where we have, we've got a good group there. We've got 401k participants, we've got business owners, HR members. We've also got a lot of advisors and asset managers in there. So tonight we've got on an asset manager, John Ruth from Build Asset Management. Really excited to have him on. John's a good guest because he comes from that advisor community. So he understands, everything that folks like me are going through. And he's got a good background as far as that. He's got some really good opinions on where target date funds are now and how they've been useful over the last, decade and a half or so. But how we're going to that next level, right? So it might be advisor models or some sort of custom target date fund solution rather than just picking a fund family off the shelf and going forward with that. So his company's Build Asset Management. He's coming to us from Missouri, and we'll welcome him on now. John, how are you?
Hey, Brian. I'm good. How are you doing?
Good, good. So I noticed that football jersey back there, so I got to ask you about that right off the bat.
That's from a time when I was as good as I once was, as Toby Keith. Yeah, that's my Mizzou football jersey. I played a little bit. I was a walk-on. I got a little playing time my senior year, but was on a really good team. So that is the 2008 Cotton Bowl jersey from the outdoor Cotton Bowl in Dallas. We played Arkansas in that game.
All right, and from there, so you spent some time as an advisor. So what would lead somebody from the advisor world into asset management, kind of on the fund side?
It was who's going to fix this problem that I kept running into. And eventually, look in the mirror, get together with some people who are smarter than me, my partners, and some of the key talent on our team is what are we going to do about this low yield problem that is really challenging conservative investors and just people who are getting closer to or through retirement. That low yield phenomenon, you asked about the jersey. I graduated from college in 2008. And so you come right into the professional industry facing an entirely different set of rules than the ones you spent, time studying to prepare to serve clients under. And it became clear that the industry was just lacking the tools necessary to serve people in this new modern low rate era. And so one of the things that Bill set out to do was to help people get to and through retirement, but ultimately help them preserve their purchasing power and do that without taking on more risk. So risk mitigation and looking for bond replacement opportunities is really what we're all about presently here at Bill.
And so we see most of the flows now are going to these target date fund solutions. And my issue with those on the advisor side is we would never sit in front of a client and say, here's your list of 20 mutual funds you can pick from, and they're all with the same fund family, right? But that's essentially what we're doing with a target date fund. We're saying your whole retirement is based on the ability of ABC fund company to be good in every single asset category, which really doesn't make sense. So let's talk a little bit about what kind of flaws you see in the target date space, and what Build can do through the 401k to help participants get to that retirement date.
I think it's just evolution, in a word. So if you pull out your first cell phone and you compare it to the one you're using today, I think you'd agree there's been some pretty dramatic improvements in the technology, and that's really where we're at right now with target date funds. History lesson, they've been around since 2006 with the passage of the Pension Protection Act. Again, a lot of the rules surrounding the interest rate equation in particular has changed dramatically since they were presented to Congress in 2006. And what that means is that they were a good V1 but now it's time to dare to continue to innovate. So I don't think they've done any harm. I think they've done a lot of good, but they are facing a lot of headwinds surrounding especially this low interest rate problem. And the question is, where do we go from here? How do we continue to make these better? And ultimately, are we achieving the goal of replacing the pension and putting people out with a dignified retirement that gives them the solvency that they're looking for? That's where we've still got some gaps as an industry. We talk a lot about the participant, the investor outcomes, but right now we don't have, as an industry, much to show for proof of the outcome concept. There's just a lot of hang in there, stay the course, and so it's that gap that we need to try to fix. So I believe in the private sector's ability to innovate. I think there's some good things happening in Congress, believe it or not, on a bipartisan basis. Like there's some good things in Secure Act 2.0, where the government is maybe going to get out of the way and let innovation happen at a faster pace. So those are good things. I think we're just getting started, and that's where people like us here at Build can be a part of the solution, Brian. It's going to be up to us to help engineer and create those better retirement outcome-based products.
Right, and one of the things that's getting a lot of play now, of course, is do we need annuities and retirement plans? As people get to 65, they've got this great big pool of assets. Now, how do we convert that into a stream of income that's going to flip the switch or turn on the faucet, whatever analogy you want to use, but that's going to drive that new paycheck for them? And I imagine that's something Build wants to be part of too, right?
I think we can help with help the insurers really in that case. Make sure that we're building the accumulation bucket to a level that is sustaining the guarantee that they're making. So we don't have a vision presently on the insurance side of the business, but for those people who kind of geek out on the investment side or the advisory side on what's under the hood of any annuity chassis, you've got two engines. One is a growth engine, and it's still going to be market returns that drive that side of the equation, and then you've got you use the faucet or the water spigot analogy. Then you've got the distribution side. So that's where you have a guarantee of a certain percent or certain dollar amount for the duration of that contract. But the two of those things need to be working well in tandem. So I think we can help the insurers keep the growth bucket, if you will, in a place where it is getting meaningful returns, but in a safe way. And that's really what insurance providers are looking for. But typically, they've been able to go to the U.S. Treasury and investment grade bond market to get those kind of returns, and they can't. So that's the void that we can fill. That means it's true for an insurer. It's also true for 65-year-old participant.
Yeah, and you had sent some slides out ahead of time that I thought were pretty interesting. And one of the things that sort of jumps off the page, and you touched on it earlier, is if you're somebody who's retired, really within the last few years or at the right time, you've benefited from a nice run in the stock market here for the last 10 or 12 years, but you've also been a beneficiary of declining yields that have forced the prices up. So you've had a pretty good run in the bond market as well. For those people who are retiring now, it's not like they can walk into the bank and buy CDs at 7%. So they miss out on that. But they've had a pretty good run here. If you're somebody who's just retired, and you can't expect, I don't think, on the equity side or the bond side, returns like that going forward. What are your thoughts there?
Well, first, when you're looking at this chart, remember it's on log scale. So this is actually all accelerating in both directions. The stock market's accelerating faster than it looks on this chart, and the decrease in yield is accelerating. So, the problem that I tend to find when I was an advisor working with people who are nearing their retirement horizon is they start to become more about managing and making sure they keep what they've accumulated, and it's less about the earn. So while the stock market is something we believe in long term, you can't adequately address sequence of return risk, or just more simply put, bad timing risk. And whether you're an insurance company, who's relying on a 4 or 5% withdrawal formula, or you're just a home gamer who's using the old 4% withdrawal rule, that should work out great unless you have one of these, critical events occur. There's a lot of studies around this that suggest that those 5 years before and 5 years into retirement are probably the most critical. If you have a sustained drawdown during that time frame, it really stresses your ability mathematically, to achieve that assumed distribution rate. Now, mathematically is one thing, but if Brian, I know you still work with plan sponsors and individuals in plans, then you've got that human element, the emotional element, and that is something that we have been unable to measure, as a society or an industry. And so it's tough then to get people to go to plan B, because usually the emotions are pretty hot when that happens. One of the things that concerns me, so I'm not here to say we're not a Chicken Little firm. I'm not here to tell you that the sky's falling in the stock market. I'm just here to tell you I'm wise enough not to know what it's going to do next. And I do think long term it'll go up and to the right. But if you really zoom in on that blue line, you'd see a lot of sawtooth patterns. You don't want to be at the trough of one of those sawtooths in those 5 years before we're going into retirement. That's just going to make things difficult. What you'll notice on the other side, the line trending down, is that we're just out of anything left to give in the yield environment. So unfortunately, our industry often looks backwards to move forward. And what I mean by that is in fund analysis, the funds that make up a component of a target date fund or a managed account, the funds that make up the investment lineup in a plan, an employer's retirement plan, a lot of times the justification used to add that investment is based on historical performance. And when you look at that chart and you see yields coming down, you have to remember that there's an inverse relationship in fixed income bonds between price and yield. And so as yield comes closer and closer to zero, over the last 40 years, it's felt like there's nothing, wrong. It's felt like, hey, nothing to see here in the fixed income space. This is doing what it's supposed to do. It's getting a meaningful return. Well, what do you do when you hit zero? You have to start going into negative territory in order to continue to get price appreciation. And while I don't think we have any slides on that in this deck that we sent you, if you ask me the question of, do we want to do that here? I think you could look over to Europe and Japan, who've got a decade or more of head start in that experiment. And the answer is no. Negative yields are not going to take you to the promised land. So this is a problem. And if you think about the way that fixed income has traditionally been used in portfolio construction, it's been the anchor in the portfolio on a historical basis. It is the ballast. It's trended to be, traditionally been thought of as the safer thing relative to equities. And they tended to behave differently than equities. So you've got this nice diversification aspect. When one moved in one direction, the other responded appropriately to help preserve. And more, at least in the more recent crashes that we've seen, fixed income has moved with equities. So we see some things that concern us. When yields are low, it's really tempting to want to reach out there to more speculative assets to get that yield. And we say, hey, throw up a big warning sign. You need to be really cautious about doing that. And so they started to develop a question that inspired our creation. How could we continue to provide something that is has a very safe-seeking profile that still gives the meaningful upside that someone needs to get them to and sustain them through retirement? Because if you look at where that chart's headed, our thesis and argument is the next 40 years, and if that means your next 40 years is in retirement, you're not going to enjoy the same price appreciation and yield coming in. You're more likely to see it remain flat for a number of reasons, and or some slight upticks. But going back to your granddad's CD rates is not something you should be betting on.
Yeah, so I'm 65 years old. I got a pool of assets. I've got 60% in the market and 40% in what? What do I do with that, John?
Well, I'd advocate for give Bill a look. You have to. Here's left to your own devices and the traditional asset mix that you find inside of plans or inside of target date funds. you really only got two ingredients to mix and match historically. You got stocks and you got bonds. So I already mentioned one of the potential pitfalls, which is stretching for yield, going down in quality, going more out into the speculative, high yield, higher risk, fixed income. But I think that's foolhardy. I shared a post earlier this morning on LinkedIn. As of September 9th, 85% of the U.S. high yield market was actually yielding less than CPI, less than the Consumer Price Index, which really is tied back to the I word, inflation. So you weren't getting paid appropriately for the amount of risk that you were taking. That's a trend you need to expect to continue. So that takes out one of the options, which is we'll just get a little riskier but still stay in fixed income. The other option that you've seen historically when there's flattening of the interest rate curve or some inverse staking effect is managers trying to barbell, meaning they go out long, maybe use like a 30-year treasury, mix that in with some shorter duration fixed income to try to get back to some average that looks more like the average duration and quality of, say, the ag, but attempting to do that with a more thoughtful approach to how they're getting that profile. Same thing, when the curve is flat, you're just not getting paid appropriately for the amount of risk that you're taking or the amount of duration you have to hold, to get that return profile. And so I'd say the last most common approach that we see, and I think this is manifested today in the most popular off-the-shelf target date funds, is you say, well, I can't use ingredient A, bonds. I'm just going to start using more ingredient B, which is equities. And that's worked out nicely from a total return perspective. But how quickly we forget, in between that has been a lot of thrash. I mean, I'm surprised still how many people don't remember March of 2020 when the S&P was down 34%. And I'm worried that we've been conditioned, as an investor community with recency bias, because we've been through two pretty major, events since, if you included 08, and you put March 2020, people go, well, it came back. And so there's, nothing to worry about. There's a lot of assumptions baked in there about how quickly it'll come back. And so again, I point to those critical retirement zone years, 5 years going into, 5 years coming out of that retirement decision. If that happens on your watch, it's really going to mess up the goals that you've laid out, the plan that you think is going to work for you.
Yeah.
And you mentioned manifesting, or I mentioned manifesting. So target date funds in 2006, when you got to retirement, this idea of a glide path, that you go on this journey of more aggressive stock-based investments to more conservative bond-based investments. Again, they've left with the same ingredients. Those funds today look more like moderate to moderate aggressive allocations, at or near retirement. I think some of the five most popular, retail target date funds average about a 60-40 stock to bond allocation to and through retirement. That's going to solve for longevity risk, but it doesn't solve for sequence of return risk.
Right, and you sequence of return, you run the risk of, if you have a few bad years at age 66, 67, 68, I mean, it's going to be tough to come back from if you're pulling money out of that. And then you've got the emotional aspect of it. If somebody has 3 down years, right into retirement, how are they going to react, right? I mean, you're going to have a large group of people who end up, going to cash and not participating in that rebound when we get one. So I want to talk a little bit about credit creation. So, one of the slides you sent was interesting is more credits created, we're getting less bang for the buck. We're not getting the same sort of impact that we saw years ago. So that's having an effect now, right?
Well, it is, and it really is the root cause for why our thesis is that this low rate environment sustains. So I think it's just one slide back, Brian, if you want to go to, there's kind of a magnifying glass. I think does a really good job illustrating the problem. It's we have been reliant upon government debt, excess spending in order to create net new GDP. And if you look, there's a divergence here that is quite clear, and it happens after 2008. It used to be that, you got a pretty reasonable rate of return for every dollar that was created, that you and I, the taxpayers, the U.S. government, would put out the door, regardless of what it was used on. It would generally find its way back into real growth in the economy. And since 2008, that's not the case, which means that our productivity rate is going down, and this creates a need for rates to continue to be low, as far out as we can see. And this problem gets worse and exacerbated when you have, sudden unexpected things come up, such as, the COVID-19 pandemic. And, what do? We turn the money printers on again to try to get people through that. So it's not unlike using your, rainy day fund as a saver inappropriately. Once it's gone, it gets really hard to replenish that, to use it for the thing that it was intended to be used for. So it is the divergence between credit creation and real growth that encourages these rates to stay lower and lower and lower. The chart that you've got up now looks at three of the more common asset classes in fixed income. They're all trending toward the same direction, including that blue line, which is the high yield. You've got U.S. Treasuries there on the bottom, U.S. corporates in the middle. So you just go back there, you're getting paid appropriately for the amount of risk that you're taking, as all of those traditional fixed income categories start to trend to zero. And you see some bumps along the way, but to draw a straight line through all those, that's definitely a declining narrative, and it is that differential between government spending and GDP that is going to encourage the Fed and Fed decisions to keep these rates historically low. And what's it mean for savers who would naturally tend to want to be in safer asset allocations? They're going to get punished, and they got to rethink how they go about their portfolio construction. And financial professionals who are allocators typically really need to be looking for innovative ways to get the returns that are necessary without taking on more risk.
Right, and getting 1 or 2% in your fixed income is bad enough, but when inflation's running 2 or 3 times that makes it even worse, especially in retirement when you don't have the opportunity maybe to go back and get another job or revisit sort of the income accumulation part of your life. So I want to get into some of the solutions that you're thinking. I mean, obviously you went from the advisor world to build, if you will. So where do you see the opportunity, and how can you help here through some of your option overlays and things like that?
Well, underpinning our thesis that rates will continue to be low and that you should be seeking quality inside of fixed income. Remember I said earlier that on that scale chart, bonds are coming down, markets are going up at an exponential rate. The Fed's decisions, the World Bank decisions around the world, are going to push equities higher. This is our thesis. And so we've developed something that just plays better, in our opinion, in this modern economic and interest rate era. And so, underpinning what we do is really a quality fixed income core. And I say quality, the majority of this is investment grade, majority meaning, 85, 90% of our flagship strategy being in that IG credit. And the remainder is in a long-only call option strategy, which is deployed on the S&P 500 or its lookalike surrogates. And then we manage that in a quantitative framework, or you could say an algorithm, that tells us how to take the gains that we get from those equity returns and rebalance them into the asset that's thought of as the safer haven, which is that quality fixed income. And that, when I say quality, it's also meaningfully low in duration relative to, say, intermediate core or ag. And so we want to be on the shorter end of that curve if rates spike, so that you can be more responsive to the portfolio long term. But this is thoughtfully designed to give you participation in those equity markets, which probably will do well long term, but it will negate the bad timing risk, that sequence of return risk. And what you end up with is something that gets you historic looking high yield like returns, or meaningful market like returns without the downside profile. So you're getting this complementary symmetric risk in the strategy. And back to what inspired us, it was that gap that we weren't seeing when we were working with participants. When I was working with individuals, we didn't feel like a solution like that existed. But again, to our thesis looking ahead, felt like something had to be developed that would fill this gap, because at the same time, you're talking about service to others. You've got the biggest wave of individuals with the boomers still retiring, at a rate of 10,000 a day. This impacts a lot of people who have worked their whole life, and really were the first set of people who had pensions taken away from them as they migrated to this do-it-yourself strategy. That's what we thought we could really make an impact, and it was getting together the right team of talented individuals to develop something that we would strive to make rigorous and repeatable, that would be defensive-minded first, but still provide that upside potential that people are going to need to make it, and need to make it, especially if inflation continues to rear its head. And I think there's probably good evidence that this is the period we're in right now is less transitory than government officials, Fed officials had hoped when the pandemic started.
Yeah, you said a couple things there that were pretty interesting. So I know you live in this option world every day, but to people who aren't familiar with it, that can be sometimes a little bit scary, right? They hear about people getting involved in options and having issues. But what's important about your strategy is it is long only, right? You're not selling anything short there. And you're participating in very liquid, if not the most liquid option market, right? So this isn't something that's that they're going to wake up one day and find out that their fund blew up, right?
Well, you're right. I mentioned you asked me about target dates earlier, and I said we're on V1, and that's going to evolve, and we'll be thrilled, as an industry that it does evolve, and that today target date funds and other portfolio construction methods are really deployed with only two ingredients: stocks and bonds. But what are we replacing, Brian? We're replacing the pension. Mm-hmm. And pensions use a number of other asset categories, to deliver that guaranteed income to individuals. And guess what? Insurance companies do too. Back to your point about annuitization. So the pros are using more than two tools. That market where we trade options has become a vastly evolved market over the last 20 years. So at a time when people were thinking about target date funds and what was appropriate inside of 401ks, there's good reason, going back 20 years, where they wouldn't have thought about this as a relevant device. But go back 20 years, we didn't think about high-speed internet as a relevant device either. So how quickly the world has changed. But you're exactly right. It's a very liquid market. We're not leveraging our option purchases. And it's a binary outcome. They can either appreciate in value or they expire worthless. And so we can quantify that in our algorithmic approach and really determine the range of expected outcomes, we would argue, much more predictably than someone who's just mixing stocks and bonds. You can do some simulation Monte Carlo analysis there, but it's all hypothetical. We know what the range of predictable outcomes is, both with a fixed income instrument and with an option. After all, really, both of those are just contractual obligations that we hold in the portfolio on behalf of the end investor. But because they're contractual instruments, there's rules. There's a beginning, there's an ending, and we know the terms of performance in between. You can wrap that up and come out with a much more predictable range of outcomes than you can with something that is unconstrained. But uniquely, options provide you this convexity that few other asset classes provide you. And I say convexity, it's the opportunity to gain more than you have allocated in the portfolio. So that's why the ballast of our approach is that investment grade fixed income. And it allows us to use a de minimis amount of the portfolio for that options exposure, while at the same time providing a much greater return profile than maybe what you would assume, by just looking at the allocations on paper.
Right, and you mentioned two big pools of dollars and insurance companies and pensions, and the other big one that comes to mind is the endowments, right? I mean, they've all gone away from 60/40, and they're all looking for alternative types of means to gain income and exposure. So so this is in essence giving those sort of strategies to the masses, if you will, right?
Yeah, and doing so in a daily tradable format. And it's this is a complicated, especially the options arena. It's quite complicated to go and do on your own, and that's why firms, who offer home trading, are supposed to require you to have, some type of more sophisticated experience before they allow you to be an options trader in their platform. So this is not something we'd encourage the home gamer to go do on your own, but I wouldn't encourage you to perform surgery on yourself either. It doesn't mean that we're not capable as a people of putting that trust in the hands of folks who are managing this every day with skill and care, the same way that a surgeon would, or the way that robotics have evolved. All things are evolving, and I think if we just look at the reality of things, it's fixed income needs a lifeboat right now. It's traditional places to manage fixed income don't look good. To us, it looks like there's a lot of headwinds, and if we continue to do the same thing, and my warning, to the investment professional industry is, if we're just backwards looking, everything's going to look fine, because the weather yesterday and the weather the last 40 years of fixed income, was 75 and sunny, and that's coming to a screeching halt pretty soon. And if we're still allocating just stocks and bonds, we're going to be literally signing up investors to lose purchasing power. Right now, the U.S. Ag is negative yielding on a real return basis. I may have mentioned earlier, high yield, 85% of the U.S. high yield market as of last Thursday was yielding less than CPI. So you're signing up for something that is by definition losing money when you factor in inflation. That's not, advisors as fiduciaries, that's not what we want to do for the clients, but they're looking for the off-ramp. And because I think right now, left with those traditional tools, their only other option is just to add more equity, and that hurts eventually. And what you've got up on the screen here now, this is my favorite internal chart to help people understand, that risk-reward framework, risk-return framework. It's an efficient frontier since our first strategy's inception and launch in early 2020 through Q2 of this year. And it plots returns against standard deviation. Standard deviation is just a fancy term for risk. And so anywhere along that dotted line, one could argue is the efficient mix of risk and return. Remember I said earlier, careful about owning high yield. You're not really getting paid appropriately for that risk. If high yield was giving you 20, 30%, maybe you'd be getting paid appropriately, but that's not the case today. And so where you'd like to be is as far up and to the left on this chart as possible. What that would tell you is that you're taking very little risk and that you're getting maximum return. So where our strategy plots, as of the end of Q2, is in a pretty nice spot. And if you compare that to what the other cohorts that are out there, this is something that's getting you at that time high yield like returns, but more on an investment grade basis down there in that shorter corporate intermediate core basis. And so that's really where we start our conversations with advisors in terms of how to position this new way of thinking, this new tool into their toolkit for deployment, whether that's addition to a fund lineup or it is an allocation inside a custom target date solution or a managed account solution. We're saying, hey, what are you doing for fixed income? What are you doing for risk mitigation? You should really consider this as a replacement. And when you mix that together, it means you can still keep your your equity conviction, your equity exposure. But this seeks to give you that more favored risk return profile.
Okay, and these strategies have been around for, you've got track record going back to the beginning of 2020. Obviously, we would never, tell anybody that that's any sort of guarantee of what we're going to see in the future. But what can we learn from this chart now, a year and 3 quarters in? How does this help us?
Well, we do get asked a lot about how we performed during the COVID meltdown. And then you said, exactly what the compliance folks would want us to say, which is that past performance is not indicative of future results. That's important, but hopefully you heard me earlier say, don't just buy things because they performed well in the past. I think that's foolhardy. But the strategy right out of the gate got a pretty good opportunity to take a punch. It was down about 6.25%. At a time when the greater market was down 34%. So that's the risk mitigation framework that we think is so important. But it's also, what are you learning from the chart? We weren't smart enough at that point in time, to deploy, say, dry powder. It wasn't like we were sitting on the sideline, Brian, and said, okay, now's the time to invest. Part of our thesis is that no one is smart enough to tell you how to time the market. So our ability from the bottom of that trough through today, to be able to continue to inch up and to the right is entirely formulaic. That is what the options exposure and the algorithm that wraps the entire device allows us to do. So this strategy is always participating. It's never out of the market. We never make a tactical decision to leave because we're not smart enough to do that. And I would question anyone who says that they are. But we've designed a thoughtful way to get that constant upside exposure without betting the farm to the downside. So I think that's what you can see here. If you take the numbers out and just look at the chart itself, it's just chipping away at that growth equation. And doing so without getting too cute on the fixed income side, which is where I think people are really going to get into trouble if they start stretching for yield right now. This whole notion, while we're there, I think your parents' and your grandparents' notion of yield cannot be the mental framework of the advisor or the client who's advising people to and through retirement today. Yield is a falsehood in many respects, and you're really going to have to look at this from a total return perspective. What am I earning on the total return of the portfolio? Does that allow me to sustain the withdrawal assumptions that I'm making? Is it the 4% distribution rule, 5% distribution? You're going to have to think about that on a total return basis, because if you stretch for yield, you're going to get your hand whacked when rates turn over.
Right. So your website is gipbuilding.com. You've got your general disclaimers there, so I'm sure your compliance folks would want us to throw that on the screen. But how do people find you, access you? How can they invest in your strategies, John?
Yeah, thanks for asking. So we deploy the strategy today 2 ways. One is in a separately managed account. That's usually for unique use cases. Today our largest separately managed account is used for an advisor who runs a pretty large managed account solution, which is a type of custom target date fund. And then the other is through collective investment trust. And so CITs are only available in certain qualified retirement plans. We're the hired manager to that CIT. It's a strategy that Alta Trust, the trustee, owns and facilitates on behalf of the participants in that fund. But that's where you can find those strategies today. Down the road, I can share with you that we have filed our ETF Prospectus A with the SEC, so we're still awaiting comment. But our goal is to incorporate a similar strategy that our portfolio team has experience running in a wrapper where advisors are telling us they'd like to use this type of approach in their wealth management or model practice. And so hopefully, maybe come back later in the year when I can share more with you about where we are on that build out. But long term, I hope people will think of Build as a fund manager who offers our unique strategies and an array of wrappers that can serve them throughout the retirement investing experience. But then our cottage approach here, our niche, is really doing this in a thoughtful way that provides risk mitigation with meaningful upside potential. And, behind the name, what really inspired us to choose the name Build, this idea that results don't happen by accident. This is true in your business and your practice. It's true in your relationships. You've got to be intentional about them. Great things are created, and retirement outcomes, have to be created also. And so we see it as our mission to engineer more efficient returns and to do so in an innovative way. And so I hope that's how people will think about Build long term. We're pretty new at this, but I think that we're coming up with timely and needed ideas. Hopefully some of the information I shared with you tonight was helpful to give people kind of that zoomed out picture of why we're here and why our thesis is that this low rate environment is going to be here to stay.
Yeah, that's good. We really appreciate it. It was good to get a look inside the bond market, where you think you're going, and also an insight at, you think of the bond market and how big it is and how many bond funds are out there. It's like, man, why the heck would somebody want to start a new bond fund? But there you are, bringing something new, something exciting to the table. And it sounds like in a few months we may have other ways to access it. So we'll have to have you on again at that point. So John Ruth, Build Asset Management, getbuilding.com. And we'll have you on again, John. Thank you.